Good afternoon, good evening to most. My name is Dan Hussey from Zaner Ag Hedge, bringing you the Strategy of the Day evening update for August 12th, 2020. Today was WASD, and remember, trading futures involves risk and is not suitable for all investors. And if you are looking to get active in the markets, be sure to talk to a market professional like myself to understand all the risk involved in trading. Everything I talk about today is just my own opinion, not a direct trade recommendation. And with all that being said, let's get right into it because we had a pretty big news day today, WASD, and really a big news week to begin with. WASD coming out today with with the USDA putting out what I think could be some of the most bearish yield reports we've seen all year. I think this was some of the worst news we could have seen hit the tapes and hit the markets, and they seem to have rallied in the face of it. And a big reason of that is, of course, because of some of the devastating storms we've seen across the Midwest over the last week, and of course some of those crop conditions that creeped up into that northeastern Iowa corridor over the last 2 weeks. Now, it is important to remember that today's WASD report, while while the USDA published a perspective for 181.8 yield for corn and a 53.3 bushel per acre yield for soybeans, those really were on both, one, the high end of analyst expectations, and two, was also off of survey data noted on the report having come from August 1st. So this means that in the run-up into this USDA report, we saw crop conditions actually improving in Iowa. Those last couple weeks in July, we saw a little bit of relief rain that caused a little bit of green to come back into some satellite imagery, and more importantly, to see some survey data that actually improved. However, the following 2 weeks up until now, we've seen pretty much drought conditions continue, with the exception of about an inch of rain that I heard fell with the storm that carried through the Midwest. However, those 70 to 100 mile an hour straight winds ended up bending down and breaking a lot of the crop, it looks like, from what we've seen. Now, all of this will come to fruition next week, and as we get into the crop tours that are scheduled across the Midwest, where we'll get some boots on the ground and actually see the devastation for ourselves. Iowa's governor had already reported that potentially as many as 10 million acres have been damaged by this storm. And if you consider the damage that could have occurred in Illinois and Wisconsin as well, and maybe parts of Minnesota, we might be closer to, in my opinion, between 10 to 20 million. Probably, I would ballpark right around the 18 million acres were affected in some way, shape, or form by this storm. I'm not saying that we saw a complete devastation of those 18 million acres, but definitely 18 million acres worth considering that we saw some form of yield loss. And that was also yield loss in the biggest producing corridor in the United States. So do we really think we're going to hit the yield expectations that here I've got Karen Braun on Twitter posting for us. Let me pull that up. Reuters strategic analyst here posting her data source, obviously from the USDA and the NASS, but thank you, Karen, for always being your diligence and posting all of this data in real time, almost real time, to the whole web. So corn yields 181.8 with 15.2 billion bushels produced. Soybean yields 53.3 with 4.4 billion bushels produced. You can see her trade average was only for 180.5. That was right where Zaner, our actual our analyst forecast was for. Soybeans were a little higher. We came in at 50.8. That was only a 1 point bump compared off of last week's or month's report. Obviously, we got a 5.4 point bump, 3.5 point bump, with trade average a little bit higher than we were at 51.2. Very, very interesting to see how hawkish most of the analysts were in going into this report. So none of us were surprised to see the USDA come in above where and adjust those yield forecasts higher, and obviously production follows for this report. But I think a lot of people were surprised to see how high it jumped given the data and given the break or the storms we'd had over the last week. With all of that being said, these numbers are important to point out to our following, because the fine people at K-State University and in their agronomics department publish a lot of great data points on their agmanager.info website. I love going there and checking out some of these yield curves. So trend yield this year on soybeans was about 50 bushels per acre. Trend yield for corn would have put us, I mean, I think trend yield for corn, I would have had it maybe at 180, 181. So we're already above where trend yield would, be forecasted for these on our USDA report. We had big weather events where we know we're just not going to get the yields out of our main producing acres. All after this report, I think that now the goose is cooked for production this year. Now, I'm not saying we couldn't see stellar weather and everything going into the rest of the year, but the fact of the matter remains that the USDA just put out a report that said soybean and corn yield would be well above where trend yield would come in. We were all expecting a knockout year for production, but don't we think we're getting a little overly bullish on the yield number? I think there's maybe a little too much optimism, or I guess fear that we're going to see a massive production. Let's take a dive and look at some of the charts here today. But I wanted to at least start off by looking at where trend yield was and put today's report in perspective of those numbers, because it doesn't all add up to me. I'm in the camp where I think now we've seen at least a short-term low. Maybe like last year, we'll see a rally into our harvest. Then once we start running combines, we'll start to see maybe some more selling pressure and put a cap on the market. Now, when we look at the charts in a moment, you'll see how there's a lot of ranges playing out in the grains. And if we were to expand that horizon and look at cattle, hogs, feeders, crude oil, silver, gold, every other commodity, even natural gas, they're all getting bids and rallying. That inflationary type pressure from quantitative easing and low rates is affecting the commodity markets in other places. And I'm optimistic that given the buying we've seen out of China and the pickup in exports and really a weaker dollar, which we'll look at here in a minute too, are all going to factor into that equation. Before we look at the charts, let's take a look at weather real quick and just focus right here on Iowa and Illinois, the part of the country that just got hit and the part of the country we're worried about some dryness. With the exception of about a half a day there of a 40 to 50% chance of rain, the next week's forecast for the Midwest is utterly bone dry. There's a little bit of rain maybe we could get up in the northern plains, but while we're talking Nebraska, Iowa, Illinois, we're looking like completely dry here for the next 7 days. That is not great given what we just came out of. These crops, obviously we need to see heat units. They need to repair themselves and regenerate. But if they don't have any water to do so, the damage from the winds and the storm we just saw could be compounded. Let's also not forget, we are unaware of how much lost corn in bins there were. There was a lot of damage across Iowa to silos. And our thoughts and prayers are out to everybody who was affected by that. If you have any information of on the ground of what's going on in your town or in your area, some fields where the corn maybe is laying sideways, send those pictures in, leave a comment below. We love hearing from you. That's the whole purpose of this group, trying to bring everybody together so that we can try to get formulate our own opinion that isn't just dictated by what the USDA is telling us. Because obviously in situations like this, the USDA has already told us we're a week or two behind on our numbers. It doesn't reflect what's there. We need to start doing that work for ourselves. So let's take a look at the charts. We'll start with December corn here today. Got a daily chart up here going back to as far back on this chart as 2018. We were obviously at a different time in the dollar, a different export market. Crude oil was trading a lot higher. Over the last year, we've seen a pretty big drop in corn, a 50% retracement for this whole decline from the 420 to 320 highs would bring us back to about a 372 area for corn. So if we're just going to revert back to the contract average or reversion to the mean for December 2020 corn, a rally back to 370 wouldn't be out of the question. Now, that would mean that we push above this July high where we obviously fell apart from and made new lows. But this 320 level, wow, have we defended it here over the last month 3 times, a triple bottom at 320. I don't really believe in triple and double and whatever bottoms. I always have a tendency to think we'll push through those levels. But the fact of the matter is that it is a highly, highly watched level now. It's got psychological factors there that I believe below 320 corn, and today's pricing starts to represent what is the price of corn before ethanol. And with crude oil recovering back to above the $40 barrel area, that is the area where Saudi Arabia and Russia got into a tiff in early March that we sold off heavily from, and actually went down to the all-time lows in the crude contract, and actually went negative in the front month futures. Now that was obviously part of the COVID collapse as well, but we've rebounded back to those levels. So when the last time we were back at $40 a barrel for corn, let's not forget, we were trading at $40 a barrel in crude. We were trading at $3.60 for corn. So now that we've gotten this report out of the way, now that the USDA has been able to warn everybody, in my opinion, that, hey, we have a record production type of year, let's not get ahead of ourselves. The Deus Ex Machina here has come in, and we have seen storms that have now changed, and weather effects that have changed that almost overnight. A short covering rally in corn, we're going to need to see it get above this 330 swing area. Remember, we have open gaps on December corn, maybe at 332 and a quarter, 332 and a half. You can see here on the chart how we had opened just lower in the overnight session back on July 27th. I would constitute that a gap, and the fact that it occurs here right around where there were these consolidative lows around the 330 area, where we're holding the lows of July until we broke down into the end of the month. Now, a more important gap to look at here is the 344 area, because 344 would fill the open gap that we left here from the start of July and coming out of actually July WASDE. So the 341 area is simply a 50% retracement from 363 highs to the 320 lows, the swing from July's highs to August lows. So getting back to those levels isn't out of the question, but obviously establishing ourselves above 330 is going to be really important, and probably the key figure to break through to think that the 320 low will hold for the time being. Going to keep a close eye on that, but I am optimistic on corn. Today was an outside day to the upside, so we went through 2 days worth of price action lows, but then ended up closing at highs of yesterday and pushed through highs of yesterday. So we've very dirty price action. It ran the high and the low from yesterday's price action here in today's trade, but that is a WASDE day. And actually a sell-off on the number and a quick snapback rally is exactly how I would expect this market to find a reversal. So I do believe we are now into a period of price discovery higher. We've got probably some short covering and maybe a little bit of a fear now that, hey, we don't know how many acres of this corn crop we could be shaving off. Are we going to lose 1 billion bushels out of production? If that's the case, we're going to be well under that 180 level for yield, and we may be back down below the 178.50 level for yield that we are at in the July report, if that's going to be the case. Today's report would very much mark some kind of capitulating low. November beans trading at 883 half into the closed above 4 days worth of highs. Also, snapback reversal, very similar to corn. I pulled up a daily chart of the November beans because it's important to remember the $10 to $8.80 range that we were in pretty much the life of this contract. Going into end of last year, we found ourselves in that $9.80 to $9 range that we broke below. I still think the $9, $9.10 area is a key line in the sand we're going to need to get back above to really, really start believing in the longer-term bottom for this market. When I say longer-term bottom, I mean year-over-year balance sheet type of tightening, not this record year of production of, we've had just years of pumping grain out of our fields at such rates that, there isn't a big surprise when you look at just simple supply and demand as to why we find ourselves in the pricing situations we do. We're just way too good at making grain. Now, 50% retracement from the 980 highs to the 831 swing lows of our last decline to start off the 2020 year, come in right around 907. So Not to say that level already traded. We already got a reaction off of it. So now the next level time up, we would be putting the squeeze on those sellers. And a lot of their stops are going to be above that July high. If we can get back up to those levels and reestablish ourselves above this 918 kind of inflection zone, we'll be back inside the trading range we were at into the end of last year. And we can start talking about maybe a run to $10 beans. For the time being, however, I am in the camp that I think we just saw maybe a low in trade. The 50% retracement from the 831 low to the 912 swing or 913 highs traded here down at the 872 area, got a reaction. We came back down, traded almost into a three-leg equal leg move down. If you're, if you subscribe to Elliott Wave or you follow any other types of pattern trading, equal legs and 100% measurements are an important factor, and particularly when they align with where 50% retracements are, I find that helps, and then add in a trend line support as well. I find that helps, build the support at that type of level. You have a confluence of multiple technical indicators telling you, hey, there's something to pay attention to here. Now, another key important factor here technically to look for is how momentum has traded out. Looking at let's look at the 4-hour momentum. That's what I was looking at before I started the video. Yeah, there it is. Our 4-hour momentum, we've seen divergence in each one of these lows. In other words, every sell-off that we've had, as far down as the market's been able to push in price, we haven't seen the market go below these two lows. The lows that we formed the low in price at. And because we've stayed above that area in momentum, and as we've pressed through each high, we have actually been gaining momentum. It is a good technical scenario playing out that we've had a pullback in price that was unable to do as much damage in terms of its strength. It has lost momentum, and now we're going to swing back the other way. If this swing takes us where I think we're going, we should be looking at a run up to about 930 in the beans before we find our next major resistance. We'll run through the 910 area. We don't really have any open gaps to talk about here for the soybean chart. Unfortunately, I'd love to say we had gaps open, but soybeans on the way down, every time we had a little gap, it filled it and traded actually very technically to the downside before now what has been about a 4 or 5 month slow reversal and turn for this market. But as things pick up here, if we see the phase one China deal pick up, we're going to see some massive price improvement. Now, this morning we did see a continued export sales fly through the flash sale, the ticker tapes, totaling 378,000 metric tons, assumed all going to China. That brings this week's total up to 1.2 million metric tons already on the books for the 2021 year. So China's already making good on their phase one trade deal. People just aren't talking about it yet. Unfortunately, this should be a big win in the president's, I don't care where your politics reside. I'm merely pointing out that the phase one trade deal was a win for Trump. Why the media is not talking about how we have just seen us go through the 50% threshold of those purchasing, I'll never know. By the way, most of that was done in the month of July, and over the last 6-week period, we've seen just absolutely fire sale to China. And again, I've talked about this before. It's very reminiscent of the situation we had with Soviet Russia in the 1970s, or the Great Russian Grain Heist, where we entered into a trade deal with Russia. They ended up buying a large amount of our stockpile of wheat and durum products, and at the end of the day, did so at a very low price. All along, Soviet Russia was touting themselves globally, maybe rubbing other nations the wrong way, and they used trade to try to, buddy up and say, hey, things are okay. Well, if that's not the situation we're finding with China right now, I don't know what is. A communist state trying to throw their weight around globally, South China Sea with India, and they buddy up with the United States trying to make a trade deal to cozy up and make things okay. Well, so long as they make good on that trade deal, I'm okay with it. And actually, given what we've seen and how they've eaten through their national stockpiles of corn and beans over the last several weeks, and how South America is running out of grain to ship them, and grain that they've been selling at a wild premium, because by the way, guys, it's going for $9.50 a bushel down in South America, the beans are. So if China is sick of paying that, they've got a 70-cent bid here to catch up, or 70-cent gap to fill between U.S. and Brazilian beans right now, and I wouldn't be surprised to see us fill that gap here over the next several weeks into harvest before, inevitably maybe seeing some more harvest pressures and another wall of grain hit this market. But something that not enough people, I think, are talking about, that maybe after this storm, maybe after we've gotten this USDA report out of the way, we'll come back to. So wheat today, not much changed on the balance sheets. And again, the chart of wheat hasn't been very changed over the last 6 to 7 months anyway. We've basically find ourselves in a big old range in that September wheat contract between the 580 and 480 area. It's a dollar range. We're bouncing around like a ping pong ball. Below 480, we could certainly turn lower. But for right now, it seems to be a line in the sand and a floor being put into the market at that price. I see nothing technically significant about this market other than a range. So, hey, on this Thursday, hopefully we'll be able to get the webinar going tomorrow. If I can't, next Thursday we'll definitely have a webinar. It's a new webinar I'm putting out. It's going to be our strategy of the week, where we'll actually take a look at some option strategies, maybe some other trading or marketing strategies, really get down and dirty into what's going on and how to play the market. In this situation, if I was to put one together for wheat right now, we'd be doing what's called a strangle, selling calls above the 580, 570 area, selling puts below 480, and just collecting premium and waiting for the market for it to come to us. Obviously, that is not a trade recommendation. I would adjust those levels. I'm simply saying selling calls up where resistance is and selling puts down where the support is when we're going sideways in a range happens to be the type of trade you should be looking for, something that simply allows time value to come into your pocket. In the meat markets, obviously we're seeing a pretty strong feeder and live and fats markets. The September feeders trading up to 148.47 half here into the close, wanting to get up to fill that 150 gap. We've also got a gap a little above us here. Oh, that is the 150. It's on the live cattle that we've got 2 gaps above us. Parabolic move. We're starting to turn higher. This feels a lot like it did, immediately following those fires last year and the response the market had. So, can we get back up to a new contract high for September? The cash markets and the cattle, it seems to be that way. We've got great margins. Cash markets are continuing higher, so I see no reason why the trend can't continue in the near term. We've got the fats, the October live cattle here, open gap at 113 and 116. I've been talking about those gap levels for a long time as potential upside targets as we trend higher. Finally, we're starting to make higher highs and higher lows month over month. That trend is continued, and we're going to be looking for the market to fill those gaps here. Can we get back up to that 120 area, get up to a new contract high for October cattle? If there's ever been a run-up that can do it, that's being really driven by strong cash and box beef cash market and box beef prices. This is it. So while we remain above the 106 area, we're starting to break above 108, and I think we're going to be on our way to fill this 113 gap here in the next move. With all that being said, that's really all I've got here for you guys today. I'll be back with you guys tomorrow, and as price action develops. The gist of the whole today, and to summarize everything, was that WASDE came out. They were way over the top on yields, well above where we'd even think trend yields would come in. And so we're going to be sitting tight here and waiting to see if next week and into the following week, the crop reports come back confirming what we all believe and what some of the rumors have started to see. Obviously, markets are forward thinking. We might see the short covering and the fear come in. And see some of that buying, really, I guess I would call it weather premium at this point, start to get baked back into the cake. So be watchful of that. And we'll be looking at some of the key technical levels like that 330 level in December corn to get through. And I didn't really give you a level here for the for our soybean market, but I would look for probably support down around 877 to 875 at this time. 885 is our prior resistance. And again, we have a little bit of a gap up at the 890 area to get back to. It's marginal at best. I hate those little ones, but Next real resistance would be at trend line up around 8.95, and of course the highly watched $9 level, which again is the high for August trade. So have a great day, everybody. Remember, you ever want to get in touch with me or anyone over here at Zaner, give me a call, 312-277-0110. Find me on Twitter and Facebook. Shoot me an email. Any questions you ever have about marketing, we are here to talk and put together a comprehensive and personalized trade plan for you. With that being said, everybody, have a great day, and I'll be back with you all tomorrow and as price action develops. Take care, everyone.